Welcome to Earnings Roundup. Today, we are jumping right into the Q3 2025 results for ROST stores, ticker ROST. And there's a lot to talk about, especially with their raised outlook and what's really driving this performance.
Yeah, this is a fascinating one. It's a great look into the off-price model for sure, but I think it's more about what happens when a retailer gets all its pieces, all its operations working in sync. The results were strong, but the story behind how they got there is, I think, even more interesting.
Okay, so let's get right into the hard data. This is for the 13 weeks ending November 1st. ROST delivered an EPS, earnings per share, of $1.58.
Which was a substantial beat. The forecast was around $1.41, so that's what, a 12% earnings surprise?
Yep.
Huge.
And the revenue side held up too.
Oh, absolutely.
Hmm.
They brought in $5.6 billion, which was well ahead of the expected $5.42 billion. All told, you're looking at sales up 10% year over year.
But the number everyone watches, right, is comparable store sales, the
Yeah.
comps. And that came in at a really robust 7% increase.
It's a huge number. In this kind of environment, 7% isn't just solid. It tells you they're taking market share.
And the CEO, Jim Conroy, he made a point of saying this was an acceleration.
Yes, an acceleration from the prior quarter. That's the key detail. They're not just treading water, they're actually speeding up. The stock was already near its 52-week high, so the market reaction was pretty muted. It was up just a tiny bit after hours.
Right, so investors were already pricing in this kind of excellence. This was more of a confirmation of that momentum.
Exactly. And when you get that kind of acceleration, the next thing you look for is guidance.
Which they raised.
Mm.
That strong Q3 led them to lift their full-year targets.
It did. They tightened the full-year EPS guidance up to a range of $6.38 to $6.46. And that sends a really clear signal that they believe these internal improvements are sustainable, especially heading into the holidays.
So that 7% comp is the star of the show. But my first question is always, is that just higher prices, or is it actual customer growth?
That's the right question to ask. And the encouraging thing here is that the gain was really broad-based. It came from both a larger average basket size and higher transaction.
Land traffic.
And traffic, yeah. The transactions were actually the biggest driver of that comp gain. So it tells you that what they're doing with their marketing and their merchandise is actually bringing more people into the stores.
And was this happening everywhere or just in the few strong regions?
It was strong across the board, which is a good sign for their inventory strategy, but geographically, the Southeast and the Midwest were the best performers. And when you look at the merchandise itself, this is where the turnaround story really gets good. All of their major categories were positive.
Okay, let's drill down on that because the ladies' business in particular went from being a drag on comps to actually enhancing them in Q3. That's a huge swing.
It's a massive swing, and it points directly to a successful fix in their merchandising. What they did, according to the CEO, was just double down on their branded strategy. They focused on delivering really compelling brand name values across all their tiers, good, better, and best.
That makes sense. So if the ladies' business was comp enhancing, that must mean it was growing faster than the 7% average.
Precisely. So if ladies' apparel was growing, say, 9 or 10%, it means another big category, maybe home goods or something, was still positive but growing a little slower. The main point is that their biggest traffic driver, the ladies' section, is now firing on all cylinders. That's what's driving the acceleration.
Pulling that off must have required a lot of inventory prep. And we saw that in the numbers. Total inventory was up 9% and average store inventory was up 15%. Is that a red flag?
It looks like one on the surface, but no, it's absolutely part of the plan. Management was clear this was an intentional build for the holiday season. They wanted to make sure the stores were packed.
So it's strategic.
It's strategic, and the number that gives you confidence in the quality of that inventory is the pack-away figure. 36% of their inventory is pack-away. That's merchandise they've bought on closeout for future seasons. It shows they're using their buying power to lock in value way ahead of time.
So this story is really about more than just smart buying. It's about integrated execution. What else did the CEO point to?
Well, the other big piece was their marketing campaigns. They basically said they needed to contemporize their approach to reach younger customers. And this wasn't about spending more money, but about making the money they already spend work harder and feel more relevant.
And where do we see the proof of that kind of synergy on the profit and loss statement?
You see it straight in the operating margin. It came in at 11.6%, which was stronger than anyone expected. It just proves they handled that higher sales volume really efficiently and kept costs under control. Yes, distribution costs were up a bit because of a new DC, but they made up for it elsewhere. That margin beat is the hard evidence that the execution is really tight.
And I imagine a 7% comp makes you a pretty popular partner for national brands.
No, it's a virtuous cycle. Better sales means stronger vendor relationships, which means you get access to better closeout deals, which then fuels an even better merchandise strategy. The whole system is feeding itself right now.
Okay, let's pivot to the biggest external risk they were facing this year, which was tariffs. They seemed to neutralize that remarkably quickly.
They did. I mean, the initial hit was real. They had a negative 5 cent per share impact from tariffs in Q3. But the real story is the mitigation. Their merchant teams just did a tremendous job. They balanced getting cost concessions from vendors, passing on some very modest price increases, and just leaning more heavily on closeouts.
And that completely de-risks the holiday quarter.
It totally changes the game. Because of those efforts, they now expect tariff-related costs in the fourth quarter to be, and this is their word, negligible, basically zero. That's an incredible display of supply chain agility.
So with that risk off the table, let's look at the actual Q4 guidance.
Right. So for the fourth quarter, they're guiding to NPS between $1.77 and $1.85. And that's based on comparable sales growth of 3 to 4%.
And how did they frame that 3 to 4%? Is that a conservative number they plan to beat?
Well, this is what's interesting. They said that number just reflects their current internal plan. It's not an overly conservative lowball. So that shows real confidence from management that the momentum they saw in Q3 is stable and already baked into their holiday forecast.
Okay, so looking beyond just the next quarter, a big part of the ROST story has always been physical expansion.
Still is. They opened another 36 ROST stores and 4 DD's discount stores in Q3. They're sticking to that long-term growth plan.
And pushing into some tougher markets too, like the New York metro area.
Exactly. The Northeast has a higher cost structure for sure,
Yeah.
higher rent, higher labor. But the strategy is that the population is so much denser that the sales volume you can do there more than makes up for it, keeping the return on investment just as strong.
But it's not just about adding new stores. They're investing a lot in the existing ones.
Right. There are two big things happening there. First is just a physical refresh. They're halfway through the entire chain, updating stores with a more modern look, better signage. A cleaner, brighter store makes people stay longer and spend more. It's a simple way to support comps.
And the second piece is technology, specifically self-checkout,
Yeah.
which can be a huge headache for retailers.
A huge headache. Self-checkout almost always leads to a big spike in shrink, which is just inventory loss from theft or error. But the ROST team developed a new prototype that they say has solved that shrink problem. And because they cracked that code, they're now going to accelerate the rollout in 2026.
And that's not just a customer convenience thing, is it?
No, it's a real productivity tool.
Hmm.
If you solve shrink, you can speed up checkout, improve customer flow, and maybe even reallocate labor from the registers to the sales floor. It's a genuine competitive advantage if you get it right.
So when you add it all up, the branded focus, the marketing, getting tariffs under control, it's clear this acceleration was driven by very specific internal strategies.
100%. This wasn't just a rising tide lifting their boat. It was driven by very specific things they did. And the really interesting part for anyone listening is that the new CEO said they are still in the very early innings of leveraging all these changes.
That's a great point. It raises a pretty big question then. If they're putting up these kinds of numbers when these initiatives are only partially rolled out, half the stores refresh self-checkout in just 80 locations,
Right.
what's the real long-term potential here? What could their operating margin look like once these efficiencies are mature across all 2,273 stores? That's the multi-year story to watch.
A fascinating prospect for future growth, no doubt.
Thanks for tuning into this earnings roundup. We'll catch you on the next one.